That 10-year note yield reaching 4%. So what will the fallout be for stocks? That is our talk of the tape today. Let's ask Adam Parker, the CEO and founder of Trivariate Research. He's also a CNBC contributor, and he is with me at Post 9. I don't even have stocks pulled up on my screen. I have treasuries, and I'm staring straight at the 10-year because that's where we're at. 4%, we're going to call it that. Hasn't been there or closed above that since November. Is that the big story?
I mean, our research this week, what we published to our clients was no matter where you were 3-4 months ago, it's very, very hard to be more optimistic now than you were then. Reason number one, interest rates, as you point out, and perceptions about rates. When we were at 4% in November, the market was 2.5 turns cheaper. The valuations really expanded. Speculation has gone rampant, right? Bitcoin's up 40% from the lows, ARK's up 40%. So you can't argue speculation isn't more rampant, valuation's more rampant. The 2-year yield is more or less at a 17-year high or plus or minus.
489, so basically right around, at 490.
Right around 2005 to 7 levels, right? So that's an attractive alternative. And I think the thing that's also come in recently that's made me a little more cautious is the 2024 earnings estimates have now been sort of posted. Analysts got the year-end 22 numbers. They sort of sharpened the pencils. They posted 12% earnings growth are now in the numbers. So I think you're worried about a V-shaped recovery in the numbers that doesn't feel likely in terms of an eroding economic backdrop. So I'm looking at now saying, okay, wherever you were 3 months ago, the rate environment and perception about rates is worse. The earnings expectations are more optimistic. Speculation is more rampant. Valuations less compelling. So the bull case is harder to articulate. It's probably something like, we modestly have a decline in CPI. The Fed kind of pauses and then positioning is offside.
But you're searching hard, though,
it's
right?
It's not the most compelling bull case where a few months ago you could have one.
Okay.
Hey, and I think that's what's changed, and that's why we wrote that note.
So David Einhorn, I mentioned, he was on with me on Halftime today, exclusive interview, said rates are going higher than people think. It's one of the reasons why he remains bearish on stocks. Let's listen.
The Fed does want stock prices lower. They've made that clear. Somehow they think if after watching the stock market go up, 7 or 8 times, 7 or 8 fold over maybe 15 years, they think if the market went down 15%, everybody would feel poorer and the economy would slow and it would spoil Christmas. That seems to be the way that they're conducting monetary policy. I think it would be better if they cared less about the stock market in either direction, but they certainly spent a long time seeming to want to drive it higher, and now they seem to want it to go lower. And the market, at least for the time being, is mostly cooperating.
Fed's the elephant in the room. I mean, as long as the Fed's leaning on the market in Einhorn's mind, how can he be positive stocks? Well, you agree with him?
He's obviously way more connected than I am, but I don't know the Fed wants something or specific about the stock market.
Well, they're not disappointed that risk assets got hit, are they?
No, I think that I agree with the answer. I don't know if we showed our work, we'd have the exact same logic stream, but I agree with the answer. I think if you're incrementally hawkish and you think the 10-year yield is going to end up at a higher level than others, you cannot be bullish on multiples. And so then the only way to be bullish is on earnings. And that just does, if you're sitting here and saying, I'm not an economist, but the world I'm living in is a probability it erodes higher than the probability it accelerates, I think so. So I think it's hard to be positioned in an incredibly optimistic way for U.S. equities right now.
But how you like small caps? Wouldn't that portend optimism? How do you like small caps in the kind of environment you're describing?
If I showed you a 30-year chart on price to forward earnings for mega, large, mid, micro, and small cap stocks, they were very, very dispersed in 2000, then all trade the exact same multiples for about 10 years, and now they're very dispersed again. So the answer to your question is micro caps are at 7 times earnings, and the market's at 18.5. So the mega caps are above 20. So I think the question is how much of that's priced in.
I would say maybe the micro caps are maybe, okay, fine, they're priced where they are. The other part of it's overpriced.
Yeah, that's right. I agree with that.
But that doesn't necessarily mean that micro caps and small caps are the place to be. They're cheap for a reason.
It could be, but it's on a relative basis. If something's at 7 times and something at 20, your outlook for 20 is probably too optimistic, and your outlook for maybe more achievable. It's a relative achievability game. You may want to own nothing, but I do think there's so much cash on the sidelines that you'll start to see some M&A pickup for these 7 and 8 times multiple stocks.
You still think there's a lot of cash on the sideline?
I do.
Because positioning I think people think maybe fueled this January rally that kind of dissipated in February.
You know, it's funny. I think the private equity businesses have a lot of things they could deploy in the public markets. You started seeing that last November when Blackstone made $10 billion investment in Emerson. You've seen Coupa. You've seen something start to percolate. There's a lot of 3 to 10 billion market cap software companies that have come down a lot that probably look attractive to some of these firms. I think the broader question you're asking, though, is challenging. It's not just mutual fund flows and retail flows and the things that old school people used to look at for cash on the sidelines. It's how much can the platforms borrow from the big banks? Because they're running a huge gross exposure, right? So if they feel like they can pick winners from losers, even if the market's going down, they could actually access more capital, and that could cause this position, a positioning disconnect.